You're listening to the Valley Current.
Almost a half a year in the book, Steve. Where's time gone?
Another half year older, another half year wiser. Right, Jack?
It's amazing to me because every day seems to get faster and faster. And I remember as a kid in school, the class had a clock, looking and wondering, when is this going to be over? You know, second grade, first grade, second grade, third grade. Things didn't speed up until probably I was in the fifth or sixth grade. Time felt like it moved so slowly, but time just moves so quickly. And there's so much information in a given day that bombards you. And the one that I sent to you, which you reacted to very quickly, was the announcement that the IRS is finally going to make a move on the stuff that Trump did in connection with his real estate and the way he did various valuations and the like. Of course, there are other people too, but they said, there's like $5 billion a year of expected revenue gain for the service, for the Internal Revenue Service.
And the really exciting thing there is that it's not completely clear that there's a law that makes what was done illegal.
Oh, is that right? I didn't know that part. Can you explain that part? Because it seems like Trump has been able to puff up his properties when he needs to borrow money, but then really devalue his properties when basically the taxing authorities are looking to tax it, basically playing both sides of it. And I sent you that notice that came in, or the news item that came in, that said, hey, maybe the IRS is actually going to do something. And you're saying there's no actual code provision that deals with this?
I'm saying that it's a gray area because of the way the assets were shuffled from partnership to partnership.
Is that right? Can you explain it?
I can say that some tax professional signed all these tax returns.
Right.
And would not have been allowed to sign the tax returns if the tax returns were clearly illegal.
Right. They had to have a good faith position for their filing position, right?
Right. And so somehow when one partnership buys another partnership, the contention of the people who take this aggressive position is that the new partnership gets the assets at full basis.
Well, then that allows them to depreciate it even more, right?
And that allows, or the people who are taking this very aggressive position are saying that, yes, they can then get a second or even a third round, actually as many rounds of depreciation as they want.
Right. I mean, I remember, I'll tell you a funny story, but when I was in second or third year of law school, I think it was the third year, you could take some electives. And one of the electives I decided to take, I specifically remember, was an elective dealing with the concept of doing deals. What does it mean, particularly in that environment, which was the 1970s, doing deals? And one of the professors said, well, a normal deal that most hotels do is they basically, when they get to the end of a depreciation cycle on a piece of real estate, a hotel, whatever that is, I forget what it is, 29 years or 29.5 years, some 31 years, you know the numbers better than I do. But basically they flip the property as a way to start a new depreciation. And that's kind of what we're talking about here, isn't it?
It is. And for residential real estate, it's 27.5 years, but it varies depending upon the exact classification of the real estate. I think there's something wrong with that, with the idea of being able to depreciate property as many times as the taxpayer wants. And it's probably a hole in the tax code that should be clearly closed. But I think it would take a court to impose penalties upon the people who've been doing this. Personally, if I were a lawyer and a judge and responsible for deciding cases, then I'd be delighted to issue penalties or even put people in jail.
You would?
If a system allows unlimited aggressive positions against the government runs out of money, right, and the system collapses. And
right.
We can no longer fund the Department of Defense or other.
The way things play out over and over again in life is like this, right? Which is the government tries to close loopholes, tries to deal with problems, tries to figure out a way to fix them. It's always piecemeal. It's item by item.
It is. And that is definitely a problem. But from an ethical standpoint, in my training, I was taught one needs to look beyond one's own self-interest and at the question of if a certain behavior were on the front page of the Washington Post and your grandmother were to read it, what would she have to say?
Right.
If everybody were to do this behavior, if everybody were to conduct their tax reporting this way, would the system break?
So are you seeing that I put the Washington Post statement saying closing asset loophole could add billions to tax collections? Are you seeing it on your screen?
I am.
Right. And it shows the deputy tax treasury secretary, looks like a young lawyer, says closing a tax basis loophole used by partnerships can raise $50 billion over 10 years. And of course, that's a lot of what Trump does, right? I mean, he moves real estate around left, right, and sideways, depending on a lot of factors, I imagine.
Yes, I assume. I'm not an expert in all things Trump. Important to point out that the U.S. gross national product is on the order of $5 trillion a year. So $50 billion is a relatively small number in the big scheme of things. But yes.
So in general, if you look at this, the hotel industry would presumably protest this, right? Because they get to the end of their cycle and they want to restart the depreciation, and they feel like that's their right almost in some ways. They bake their plans in based on that view because the depreciation is a pretty large offset against the revenues they make from renting out the rooms, right?
It is.
So, I remember this class from, of course, 45 plus years ago, or 40 odd years ago. And I'm trying to remember who taught it. He was really a very, very conservative tax lawyer. And I even remember back then he questioned whether this was the right thing to do. But he said, this has been allowed forever. And this was back, 40 odd years ago, that he was questioning it, saying, this is just form over substance, right? The title moves around, it gets to have a new cycle. And maybe there's some improvements that are made along the way and so on, but they don't knock down the hotel and start over again. They don't rebuild. Sometimes they do, obviously, in Las Vegas.
Well, this is one of the big advantages of real estate as an investment. It is that tax value of the property is going down and creating a deduction called a depreciation shield, whereas the economic worth of the real estate, in particular the land, is increasing. And so eventually the investor, the owner, is going to pass away, and then the basis of this whole thing gets stepped up on the passing of the owner, and nobody ever pays taxes.
Right. So you're saying real estate has kind of a preferred status in the tax code for a variety of reasons. We've listed some of them before, including that you get, to some degree, a home interest deduction. You get the ability as a married couple to have a $500,000 freedom. The first $500,000 of gain is free of any federal tax, maybe sometimes even in some states free of any state tax. And you get the advantage of the accumulation of appreciation, not depreciation, but appreciation, is happening year to year without any tax reporting. It's just a long-term appreciating asset. And if you were a perfect couple with a perfect wealth mentality, and I think there are a few of these people around, you'd basically live in a place, fix it up every 2 years, try to sell it for the maximum amount, take that tax-free money and kind of replay it in the market over the course of a 50-year marriage. You might actually have 25 residences, right? I'm just doing high-level numbers. I don't think anyone has set the Guinness Book of Records for this, but in theory, it's possible for a couple to maximize their wealth in real estate, in even residential real estate, right?
Yes, indeed. There are some systematic justifications for the step-up basis and the increase in value when somebody dies. Incidentally, in a community property state, like here in California, if either spouse dies, 100% of the property gets stepped up in basis to the surviving spouse.
Right.
From a systematic perspective, I'm going back 30 years to figure out what your grandparents paid for the property is unrealistic and unlikely to produce an accurate number. It's also a case could be made that the benefit of doing that research is not worth the accuracy that it might provide, and that we're better off to forego the research into exactly what the costs were over that 30-year lifetime. It could be longer. It could be a 100-year lifetime. Right. And should those numbers be adjusted for inflation? Well, all these questions arise that are simplified by just the decision to step up the basis.
Yeah, and the stepped up basis is pretty significant because there are many examples in Palo Alto in particular where older couples in their 80s and 90s, one of them dies, and they live in, say, Professorville or downtown Palo Alto or any of a number of neighborhoods in Palo Alto that have seen immense appreciation. They bought these houses for like $10,000, $15,000, $20,000. They're selling mainly for the dirt because a lot of times the house gets knocked down for like $15, $20 million. So the step up in basis has an amazing effect because it's shielding what would otherwise be, a huge gain, a huge, capital gain from a tax point of view, right?
Yes.
And it's shielded both from federal and state in California, isn't it?
Yes.
So if you think about the tax savings, it's in the millions. I mean, it's literally in the millions. So this is the opposite view, that you stay in the house for a long period of time as opposed to, flipping it every 500,000 of gain somehow. Although I guess if you flipped it enough with the right leverage and you were in the right zip code with real estate appreciating, maybe you would end up getting a far better outcome than even that long term. But I have to tell you, a lot of the people that bought in Professorville and other places in Palo Alto, downtown Palo Alto in particular, they're extremely happy with the way things played out over 30 years. And of course, they paid their mortgage for 30 years. They may have even hit their 50th anniversary as a couple, maybe even their 60th anniversary. And you get to the point where it's like they're better off staying in the house until one of them dies than actually trying to sell the house. Because if they sell the house without converting it into a 1031 exchange, they're going to get hit for all those taxes, right?
Right.
I mean, it's an amazing thing because it also ties to if the kids want to take over the house, they kind of have to worry, well, what are the real estate taxes going to be? In terms of taking over that, since the house is worth a lot more. And over time, whoever does buy it and renovate, it's got to be pretty wealthy because they're going to pay higher real estate taxes on it, right?
So this is not a do-it-yourself situation from a tax standpoint. There are several gotchas. First of all, to your point as to which is better, the flipping approach or the defer until you die approach.
Yeah.
In my experience, I've signed numerous tax returns that had millions of dollars of pre-tax benefit from the step-up basis.
Mm-hmm.
And I've really seen similar benefits from flipping. And with flipping, there's a risk. There's actually a bunch of risks.
Oh yeah, I mean the risks are huge. You could get into a property at the wrong time, and all of a sudden it's drifting downward, and you're stuck, and it could have many issues. I mean, there's lots of risks. I'm just saying, in this perfect world, I sometimes get students that I teach in business schools and the like, and they say, "Oh, well, what would you do if you were us?" graduating from college or graduating from graduate school. And normally the answer is you buy a house and you try to get the biggest, most reasonable loan on it that you can. But now they say things to you like, a house, it's a lot of maintenance. I could put the money into cryptocurrency. I could put the money into the stock market. There's a stock called NVIDIA. It's gone up tenfold in the last year or two. They have an answer, which is, who wants to buy a house? It ties up a lot of resources. It puts a big debt over your head. And, obviously when interest rates are high, the answer is, well, maybe you don't want a house. But in general, this idea, when you transform it over to the commercial side, commercial buildings eventually run out of their depreciation. And then they become like, we've got to sell it. Right? Or got to do a 1031 exchange or do something, right? To basically restart some new value creation. And I think that happens in the hotel business. I think that happens in the office park business as well.
Though I still am not comfortable with the ethics of restarting the depreciation. It would be possible, in theory at least, for somebody to make a purchase that's on or about December 31st and deduct that purchase this year, and then on their next year tax return to deduct the same purchase a second time.
Mm-hmm.
And that's clearly wrong. And in fact, there's rules against that. And if you get caught doing that, you can potentially get in big trouble.
Mm-hmm.
Now, we've had several years of low enforcement from the tax authorities, but I have seen taxpayers who have done very sketchy things and who have been put on a list of for permanent audit.
Mm-hmm. That's Trump. Trump is in permanent audit mode, isn't he?
I once saw a particular taxpayer who got audited every year.
Mm-hmm.
And every single number on the tax return was checked to the dollar.
Right.
And the firm that did that tax preparation work generated about 5 feet of paper for that client each year.
Right.
And probably a $50,000 tax preparation fee.
Right.
And that's for life. And I don't want to get on the list. I don't want any of my clients on that list. And I don't think they want to be on that list.
Yeah.
So if I get a client that wants to do that double deduction thing, and I became aware of it, I would not sign the tax return as preparer, and I would not continue with that client. And if I knew that they would take positions like this, I would not take that client in the first place.
Yeah, I mean, I think that's kind of always an interesting question, which is the range of clients that any professional gets, whether it's an accountant, a lawyer, an architect, even to some degree. You can go down a list. There's a range of risk taking that each of them are willing to do. I mean, we do litigation all the time. Different clients have a different range of risk adversity. Different clients are more interested in taking the risk of the reward. It's just like a stockbroker. I mean, to some degree, the stockbroker has to know, is this client want to be speculating, or does this client just want everything in T-bills? And that's a big know your customer kind of area for stockbrokers, and matching their risk tolerance in terms of what they're allowed to do and what they're not allowed to do. I mean, Trump probably pushes the envelope, not to make the whole discussion about Trump, but in many ways, he, along with people I would imagine like Elon Musk, because clearly Musk is in the news as well. When I saw this news item, I thought of Musk because he's been fighting the SEC, who complains that he didn't report on some of his acquisitions of Twitter before they made the tender offer to the rest of to the board of Twitter for buying the rest of the company. He just didn't report his insider purchases. That's illegal. I mean, that's arguably illegal. At least there's an SEC rule on it. Now, whether it's actually subject to some criminal or civil liability is the next question. But he did it. And I imagine the lawyer said, well, ordinarily we disclose it, but once you disclose it, the price of Twitter is going to go through the roof. So you're going to pay a lot more money for the acquisition, because speculators are going to come in and say, hey, he's making a play for the company. So he decided not to disclose it. And, it takes a certain character to accept the risk that you may have to go to jail. If the agency decides to go and file a criminal case and you lose, you may end up in jail. Just like you could say, probably some lawyer and likely some accountants and tax people said to Trump or said to his CFO, who did go to jail, Mr. Weisselberg, hey, listen, you're pushing the envelope here on what you're doing. You're saying this apartment is 30,000 square feet. The apartment's like 10,000 square feet. You're pushing the envelope. If they decide to take issue with this, you may go to jail. That would be what a professional would normally say. And sometimes would say it so forcefully, would say, I'm going to have to resign from representing you because I can't allow a criminal act to occur. Now, where the line is between really super aggressive behavior and an actual criminal act, that's often very gray and depends on lots of facts and circumstances that have to be analyzed for each individual case. In Trump's case, it seems like everything pushes the envelope all the time. And maybe that's the way you become a billionaire. And maybe that's even true in the case of Elon Musk, not to put Musk.
Getting to that analogy between Musk and Trump, didn't the SEC at one point require that Musk clear any statements or press releases, almost to the extent of something that might be called a gag order?
Yeah, they required that there be kind of a person or maybe a committee that looked at what he was about to publish before it was published. And so they would own policing role so as to let him still have his First Amendment rights, but with some, non-governmental review effectively. Now, whether those people were lackeys or, where those people fit into the scheme of things, I don't know, because he has said many things on Twitter that have caused stock prices to move. And obviously, a tweet from him can move a market. And people that do, speculative type trading, they look at his tweets. In fact, they look at a lot of things that are on Twitter. In fact, I think there's even a product on the market. It's called Ticker Tags that looks at social media and surveys all social media 7x24 by 365 and looks for what's trending in social media as a way to see what's the next hula hoop, like what's the next big fad, what's the thing that's going to move a market. It's a very expensive product, probably mostly hedge fund clients, but it was developed by a guy that figured out that, hey, there's another form of analysis other than fundamental analysis and other than chart-based technical analysis. There's a third type of analysis. It's called social media analysis, because social media is causing decision makers, including investors, to take action. And so if you watch for the trends on Google, Twitter, Facebook, Instagram, I imagine this tool goes out to everything. It can give you a read on where things are going and how people feel about where things are going. It gives you a sense of the pulse of, is the economy retracting or is the economy expanding? And that pulse can be used to trade indexes, could trade futures, to trade stocks, to trade bonds. And that's what they do. And they kind of beat the market. They essentially beat the market by having advanced knowledge that's coming out of that system. So this is a long answer to these folks with power. I mean, look, Trump has his own social media company because he was, pushed off of Twitter. Musk bought his own social media company. It's kind of surprising to me that we haven't seen Bezos. He bought a newspaper instead. He owns the Washington Post, which is the article that inspired us to have this discussion. But as a general proposition, folks with power generally like to have some amplifier for the way in which they can express their power. Trump is one good example of it. Now, it'll be interesting to see whether any of this actually filters down to him in his lifetime. I guess it depends on how long he lives. But if it does, and it causes some sort of re-review of all of his federal tax returns, I imagine it will be like a massive case. I don't know, how many years can they actually go back in looking at those returns, Steve?
Well, I think that since they are auditing nearly all of his taxes, they can go back until each audit closes. So an active audit will keep the statutes open, will toll the statutes indefinitely.
Wow. So that could be like a very long period of time then, if the audits are going on for a long period of time. So say his expected lifespan is to age 90, which probably is giving him a lot more credit, given the sense that I get about his own sort of aging process. He's 77 now, I think, or 76. So in 14 years, if all that period is still going on, he may not be around. And I guess at that point, the real question will be, is the stepped up basis rules still enforced? And in the context of all of his real estate, do they actually make a difference in somehow enabling his children, presumably his children, I guess from 3 different marriages, to be able to take advantage of all that wealth that's based in all that real estate, right?
It's an interesting question. And looking back, maybe 6 years ago, I had a client who actually wondering whether she could take advantage of any of the loopholes that Trump was using. Mm-hmm. And she came to me and asked for advice as to how to take advantage of some of these loopholes.
Yeah, it's like the next book of Trump, if he succeeds, would be not the art of the deal, but it would be the art of avoiding taxes, right?
And so I told her that I did not want to see her in a jail cell next to Trump. But of course, if events move differently and he's not facing potential jail for tax evasion, he's facing potential jail for adult entertainment.
I mean, there's so many different aspects to what that case is. It was called the zombie case for many years inside the district attorney's office. A guy wrote a book about it and said it was a case that just couldn't seem to die. He ultimately quit over a disagreement with the New York district attorney's view about whether that case or some case should be brought. But, overall, I have to say, just generally speaking, Trump has survived in a very surprising way over the period of his lifetime, because he's sort of been able to deflect over and over and over and over again every bullet that's been fired at him. And, a big decision is going to come up shortly from Judge Merchan about what to do, whether to fine him, jail him, give him community service, let him survive all this. Like, it's a big decision. It's not a small decision. So it'll be really interesting to see what plays out there. In the meantime, I guess this tax stuff just continues to roll on. But the point of it is, in many ways, his pushing the envelope does cause a certain development of law and a certain development of policy and regulation to take place. And maybe there is some good in that over the long run, in that pushing the envelope. At some point, you might say that does enable the law to be developed and not to go undeveloped. But for all those hotel businesses, they probably would prefer if he just remained silent, because in many ways, they may end up having their businesses hurt as a result, right?
There is one group of clients and taxpayers to whom I want to call the attention that these bypass trusts that were very popular 10 or 20 or 30 years ago. And many of my clients continue to have these bypass trusts. They can have very unintended side effects that are worth revisiting at this time. Mm-hmm. One of which is that if a trust owns real estate at the time of the taxpayer's death, they do not get the step-up basis. The step-up basis is only for assets that are owned for an individual. One more thing here is that trusts are not eligible shareholders for S-corporations in general. And so it's very possible, and I've seen situations where S-corporations lose their S-corporation status as a result of an inheritance or conversion into a trust. Right. So anybody with ABC trusts, please consult your advisor about the potential for problems.
So let me
releasing it when you're under audit. So you've got to ask yourself, why won't he release his tax returns? And I think there may be a couple of reasons. First, maybe he's not as rich as he says he is. Second, maybe he's not as charitable as he claims to be. Third, we don't know all of his business dealings, but we have been told through investigative reporting that he owes about $650 million to Wall Street and foreign banks. Or maybe he doesn't want the American people, all of you watching tonight, to know that he's paid nothing in federal taxes, because the only years that anybody's ever seen were a couple of years when he had to turn them over to state authorities when he was trying to get a casino license, and they showed he didn't pay any federal income tax. So
that makes
if
me
he's
smart.
paid zero, that means zero.
That makes me smart. Did you get that little quip that he put in at the end?
See, I understand the tax code better than anybody that's ever run for president. Hillary Clinton, and it's extremely complex, Hillary Clinton has friends that want all of these provisions, including they want the carried interest provision, which is very important to Wall Street people, but they really want the carried interest provision, which I believe Hillary's leaving. It's very interesting why she's leaving carried interest. But I will tell you that, number one, I pay tremendous numbers of taxes. I absolutely used it. And so did Warren Buffett. And so did George Soros. And so did many of the other people that Hillary is getting money from. Now, I won't mention their names because they're rich, but they're not famous. So we won't make them famous. So,
can you say how many years you have avoided paying personal federal income taxes?
No, but I pay tax and I pay federal tax too. But I have a write-off. A lot of it's depreciation, which is a wonderful charge. I love depreciation. You know, she's given it to us. Hey, if she had a problem, for 30 years she's been doing this, Anderson. I say it all the time. She talks about healthcare. Why didn't she do something about it? She talks about taxes. Why didn't she do something about it? She doesn't do anything about anything other than talk. With her, it's all talk and no action.
So I put that on because I think it's kind of instructive.
Now she's blaming. Hold on. She got caught in a total lie. Her papers went out to all her friends at the banks, Goldman Sachs, and everybody else.
Okay, Donald.
She said things, WikiLeaks, that just came out. And she lied. Now she's blaming the lie on the late, great Abraham Lincoln. That's one that I haven't heard. Okay, Honest Abe. Honest Abe never lied. That's the good thing. That's the big difference between Abraham Lincoln and you.
What's going on here? Am I just
That's a
totally
big difference. We're talking about some difference.
Anyway, Steve.
He just won't shut up.
He won't shut up, and I couldn't stop him. And
it's much easier.
I'm going to have to shut this down because I don't know the way to stop him.
Then what?
Because he's taken over my computer.
And I said,
Anyway, Steve, it's been good talking to you, and we'll get together soon. Thanks for being on. Talk to you later.
Likewise.
Okay.
Isn't technology great?
with the exception of the late, great Abraham Lincoln.
Tune in next time on the Valley Current.